All right, friends, welcome back. We continue with our IFRS 15. So we're looking at the third point in terms of the model where we determine the price. And within the price, we're saying that there could be four different elements. There could be variable considerations, complete on time, get a bonus, complete late, pay a penalty. Okay. We could also have financing. I give it to you and it takes a while for you to pay. And you tell me that you pay over a period of time. So I need to discount it. Okay. We could also look at where we produce or supply to the customer, and he decides not to pay us cash, whether now or later, but decides to give us some shares. We're saying that if that happens, value the shares at the current price, okay? And and then we're also talking of where we pay a consideration to the customer for some services, distinct services he offers to us. Now we took an example where we looked at the individual, we're giving the person the cash consideration. But however, it wasn't anything unique to us as the suppliers, but to himself. He's just redecorating or expanding his retail outlets to ensure that he can contain or accommodate or warehouse, store these goods that we are sending to him. We want to take another example on financing. Okay. And then the rest, I think, share price, we can leave that one. It's easy to compute. Penalty or variable considerations, penalty or bonus, for example, we always look at where the circumstances typically tell us that this will likely happen. Therefore, you recognize it. Okay. So let's go to the financing, which would take us um, for the remaining section. Again, I'll be watching my time. If it happens that it's going beyond the threshold of 30 minutes, we will cut it off and come again. Okay, so this was, let me be sure where we got to. Okay, so this is what we got to. Now let's move on. Financing element, we're taking an example. For example, Rand Company enters into a contract with a customer to supply equipment on 31st December 2011. Control of the equipment will transfer to the customer on that date. The price stated in the contract is 1 million and is payable when? 2013. Can you imagine? We supply the goods to you on this date and you pay us 2013. How many years? 2 years. 2 years later. Okay. Market rates of interest available to this particular customer is 10. So it's more or less, it's like we're giving this guy a loan and then he'll pay us later. Okay. That's why we see them as debtors. They owe. Okay. So typically what we would do is that the 1 million that he's going to pay us in 2 years, time value of money will tell us that that 1 million that this guy is going to give to us is not the same as 1 million today. So let's discount it to find the present value. Then we calculate the interest on this present value for the remaining years. Okay. So it happens that what we'll get is that the 1 million will have to be discounted. Okay. Times the discount factor. So the same discount factor or discounting formula that you know, which we even looked at when considering the purchase consideration of of a subsidiary where we are having deferred cash payment. It's the same story here. Okay, so it will simply be 1 over 1 plus the rate to the power n. N is the time. Okay, so we're going to multiply this against the discount factor. So what we'll get here typically will be our 1 million times 1 over 1 plus the 10%, okay, raised to the power 2. Okay. So let me use this space here. So our 1 million will be discounted by 1.10, right? It's 10% to the power 2 years for us to get the present value, okay, of the reality. What does it mean? Okay, what is the actual value of this 1 million today? The reality today. Okay, so I've done that, but we'll come back to it again. Let's work and see. So we say that due to the length of time between when the asset gets to this customer for him to control, use it, and the date when he decides to pay us, there's a significant financing component here. There's a big credit element there. The consideration that we are paying should be adjusted to reflect this financing component. Okay, so we use a discount rate which has been given, and we are saying that the discount rate should reflect the available rate to the customer. It is more or less what that we are saying is that we are giving this guy a certain amount, and he's actually going to pay us interest. But when we include that interest at the end of the day in 2 years' time, it will amount to 1 million. What amount is that? What amount are we giving to this guy? So we said revenue should be recognized once the obligations have been satisfied. As such, revenue and corresponding receivable will be recognized. Okay, so this is what we calculated, and it gives us this amount. It tells us that more or less, in simple terms, to someone who is a layman, we are giving this guy 826,000 today. Now, it's like a loan we've given to him. He's going to keep it. Next year, we charge him 1%. Sorry, this year we charge him 10%. Okay, this year we charge him 10%. Next year, we charge him another 10% on the accumulated amount. Then, at the end of 2 years, it sums up to 1 million for him to pay us. Simple as that. Okay, simple as that. So in the first instance, what will happen is that in the first year, they said in the years to 31st December 2021, that's year 1, right? And 2023, this is a year 2 because the first one starts with 31st December, okay, 2011. As we unwound the discount, RAD Limited will recognize the finance income in the statement of profit and loss. Okay, so what we do is that this guy owes us today. We debit our receivables. Okay, we debit our receivables. The finance income will increase the balance by debiting the receivables, and then we credit the finance income. At the end of the day, once it materializes, this guy will pay us cash. Once he pays us cash, cash will be debited, and then the total receivable amount will be credited to close it off. Okay, that is it. So presented in this format, this is the figure we give to him. The amount we discounted, the 1 million discounted gives us this, okay? So the 1 million discounted gives us this amount, okay? Gives us this amount. Then we apply 10% interest on this, gives us this. So more or less in year 1, this is what he will pay as finance income, okay? Then we will credit finance income here. Okay, we credit finance income and credit and debit the receivable with the interest component. And then in the second year, we get a total of this, right? We apply 10% of this on this one. We credit finance income and then we debit our receivable with this portion. And then at the end of the 2 years, realize that it sums up to 1 million. If he pays us cash, we reverse it by simply crediting our debtors account, okay, and then debiting our cash or bank account to close it off. Okay, to close it off. All right. That should be it. That should be it. Okay, so on 31st December, like we're saying, if he receives cash, we debit the bank, we credit the receivable to clear the outstanding. That's it. Okay, to clear it. That's it. All right. Now let's go to step 4. Step 4 of the 5-step model. Step 4 is saying that once we've identified the price, let's allocate it. Allocation, which one goes to where? Okay, so the total allocation should be, the total price should be allocated to each performance obligation in proportion to standalone selling prices. So if you have the selling price, the transaction price this way, standing alone, was there the specific provision of goods and service? Was there any provision of another? Maybe it was a car we sold, okay? So we sold a car. And then the second one possibly could be the maintenance, okay? So if the total was, let's say, 12,000, we have to split this 12,000 between the car sales and the maintenance portion. Okay, we split them. If a standalone selling price is not directly observable, we just use an estimate. If a standalone price cannot be determined, use an estimate. What others could have done easily on the market. So let's take an example again, once again. So Shred Company sells a machine and 1 year's free technical support of 120. So the total cumulatively is 120. It usually sells the machine for 120, but does not sell technical support separately as a standalone product. We are told other services that are supplied by Shred Company attract a markup of 50%. It is expected that the technical support would have cost 20,000. So assuming the technical support was given alone, it would have been 20,000, the cost. And then this guy will apply the 50% to get a profit. Okay, 50% of this is what? 10,000. Add it to the cost of 20,000 to give us 30,000. So actually, this is what he would have given. Okay, this is what he would have given. How should the transaction price be allocated between the machine and the technical support? Okay, okay. All right. So let's get some notes before we move on. I tried working on some of the notes in the earlier portion, but let's work on it here. So here we are saying that observably, what we can get in terms of evidence is that we sold the machine for 120, and we said it includes that maintenance, okay, free maintenance, but actually the maintenance has a cost. Now there is no observable price for the technical support. We said it is infused within the sale of the machine. So therefore, the standalone selling price needs to be estimated. And we estimated that in reality, it would have been 20. Other services would have been 20,000. So if we apply the 10% to it, it will give us the 50% to it. It will give us 10,000 plus the 20,000 gives us our 30,000. Okay. So one approach is to use the margin approach. We know the cost markup, the percentage that will add to it to make our profit. So we are going to be getting 30,000 for the support. Okay, for the support. Now the total standalone price of the machine and support should have been 150. Should have been 150. But we gave it to this guy for 120. What comes to mind here? It looks like we've given this guy some discount. It looks like we're giving this guy some discount. Because he's buying the machine altogether, we've given him extra 30,000 for free. Okay, so however, total consideration, like I said, is 120. It means this guy is getting a discount. And what is the discount he's getting? He's getting the 30,000 for free. So 30,000 as a percentage of the 150,000, which he should have paid, would have given us a 20% discount that he's enjoying. Okay. Now, IFRS 15 says that an entity must consider whether the discount relates to the whole bundle or to a particular performance obligation. In the absence of additional information, it is assumed here that it relates to the whole bundle. Here, there's no much information in the question. So we'll assume that the whole 20% applies to the bundle of machine purchase and the maintenance. 20% applying to all. So the transaction price should be allocated clearly. 20% was given to this guy. So in reality, the 120,000 should be allocated as 80% for the actual machine. And then the 30,000, which should have been the equipment maintenance, should also be discounted by 20%. Okay, to reflect an 80% which we gave it to this guy. Okay, I don't know whether you're getting me here. So at the end of the day, in reality, the maintenance is 30,000. The machine is 120,000, right? This guy enjoyed 20%. Therefore, it means this was given to him not at the full 100% price, but was given to him at an 80%. This machine, actually, we are told, it contains a free maintenance. It means that this 120 was not given to this guy at the full 100%. It was given to him at a discounted amount of what? 80%. Okay, so the 80% of the 30,000 gives us this 24K. Okay, and then the 80% of the 120 gives us the what? The 96K. If you add these two together, you end up getting the same 120K. That is it. Very easy. Okay, very easy. Now let's move on. So that is it. I hope we all get this one. Okay. All right. Let's go to step 5 to finish it. The steps. So revenue is recognized when. So we say now we recognize it. Okay. COPA. Recognize it. Okay. So we allocate and then we recognize. So recognize when or as the entity satisfy a performance obligation by transferring the goods and services to the customer, right? But here, two things happen. Two things happen. An entity must determine at the contract inception whether it satisfied the contract obligation over a period of time or at a particular time. Now, if it satisfied the performance obligation over a period of time, then measure the progress over that period of time. What was the progress at this stage? Normally, you see it in the construction of roads. You don't just go and stand on the road or even building contracts and finish it at a point. It goes stage by stage, step by step. But there are times that you go on to the project once and for all and you finish it. Okay. So if it was not satisfied over time, then typically we are saying that it was satisfied at a point in time, once at a very particular point in time. Okay. We'll take these two elements one after the other. We'll deal with the over the period of time and we'll deal with the particular time, okay, briefly. So what we are saying is that over a period of time, to satisfy it over a period of time, there's a satisfaction criteria which IFRS requires us to note, okay. If it is over time, then it means one of the following is met, okay. IFRS 15 states that an entity will satisfy a performance obligation over time if one, if you meet all of them, that's good. But if one is met, one, the customer simultaneously receives and consumes the benefit from the entity's performance. Receives and consumes at the same time. Road is constructed. Portion is finished. The cars will still work on it. They'll use it. So the state receives it, cars start using it simultaneously. Okay. The entity is creating or enhancing an asset controlled by the customer. So another point is that where the seller is creating or enhancing an asset which is already in the possession and control of the customer. So he's using this machine. We go there, we adjust, we install something, but he's still using it. Okay, he's still using it like a software design. We are using Aula sometimes. We are using Moodle sometimes. The software engineers are still working on it, upgrading it, whilst we are still using it at the same time. It's in our domain. We are controlling it. Okay. Then we also talk of the entity cannot use the asset for an alternative use. Okay, the entity cannot use the asset for an alternative use, and the entity can demand payment for its performance to date. So I've done it. I've finished the product. I'm not using it for anything. Okay, and I can demand that as at this level where I've gotten to pay me. It's a construction thing I'm doing. Or I'm building a particular machine for you. I cannot use it for any alternative activity. So at a point in time, I tell you that I've finished 80%, pay me up to 80%. When I finish the remaining 20%, you pay me. So if any of these is met, then we can say the criteria has been satisfied. Again, under the same satisfaction criteria, if a performance obligation is not satisfied over time, like we said, it means that it is satisfied at a point in time. We'll look at that later. Now, if the performance obligation is satisfied over time, we must recognize revenue based on the progress made. 20% completed, recognize revenue at that stage. 80% recognize stage by stage. Okay, it makes sense to recognize it that way. So this is the scenario where we use the progress measurement method, the input method, and then the output method. The input method looks at cost, total cost incurred as a proportion, the current cost I've incurred as a proportion of the total cost. So total cost is expected to be, let's say, 7 or let's say 100. But currently, I have actually incurred 80. So I express it as a percentage, okay, and it means that progress made is 80%. That's the input cost. Input is cost, okay. And then we have the output method, which talks of how much of the work have I completed, okay, as a proportion of the total contract price. So I'm expected to receive, let's say, 100. Okay, that's the total contract price. But currently, I have received, let's say, 50 to signify the portion of work which I've completed. So 50 over the total contract price will give me the percentage that I have finished, okay, which gives me a 50% progress, which I need to recognize. Let's take an example. Mendy entered into a construction contract to build an office block for a customer. He's entitled to payment for work completed to date. Under IFRS 15, this would mean that Mendy's performance obligation will be satisfied over time. Details are as follows. Contract price, the total is this, goes into output. Cost that I have incurred to date goes into input, okay? And this goes to output, okay? Estimated cost, again, goes to input. And then the value of work that has been satisfied to the value of work goes into output. Okay, so the input method is saying that the cost I have incurred to date, the 300,000, okay, expressed as a percentage over the total cost. That is it. Okay, and then the output. So this is the input. Okay, this is the input, and then the output is saying that the value of work that has been certified to date, that listen, this guy has done up to this level, pay him, is a 400. Okay, that's the value certified over what? The total contract price that he would be paid if he finishes everything. That's it. And we express it as percentages. Okay, so you find it that 300 over the total contract price. Okay, total cost. The input method, okay, will then give us 75. And here the value certified, okay, value which has been certified over what? The total contract price. Okay, I'm checking my time. And maybe we'll end it here. Okay, and come to the next one. So let's do one or two before we wrap up. Again, in terms of performance obligations satisfied over time, we should consider the contract cost and any assets and liabilities. Okay, we take it one step at a time. So we must capitalize or recognize an asset. Okay, one, for example, and it should include the cost of obtaining the contract and any cost of fulfilling the contract that do not fall within the scope of another standard, such as IAS 2, which is inventories. Okay, so any cost we incur in obtaining the contract goes into the capitalization or the recognition of the asset. And then the cost of fulfilling the contract, provided it doesn't fall within any IFRS scope, should also be included. These capitalized costs would then be amortized continuously to profit and loss as revenue is recognized. Okay, beautiful. Now we need to recognize an asset like we just mentioned above, and then we need to look at the liability. Now, this is where we consider the contract as a contract liability. Now, the entity should recognize, assuming the entity recognizes revenue even before the entity or the seller receives consideration. I have recognized revenue even before I receive the recognition or the consideration. Then what should happen is that, revenue has been recognized, credited. you should recognize the corresponding element, a receivable, provided there is the right to the consideration being unconditional, no condition attached, unconditional. Then we would recognize the corresponding entry to be a receivable. Otherwise, the corresponding debit entry should be a contract asset. So I have recognized the revenue even before I get the consideration from the seller, from the customer. Either a consideration, whether either a receivable is recognized, provided there's no condition attached, or I recognize an asset, a contract asset. The flip side gives us the liability, okay? So here, a contract liability will be recognized if I have already received the consideration even before I recognize the income. So this is where I was talking earlier. I was talking about earlier that you've been given the money to do the work. You've not even started or you've not completed. You are not even sure whether you finish. But you've been given the money. It's like a deferred income. Okay. What do? Recognize it as a liability. And once you meet the conditions, you can then reverse the liability. Okay. And then recognize the income. That's all. That's what we're talking about over here. Okay. So this is normally calculated in terms of the asset or the liability. Okay. It's calculated as the cost to date, the total cost to date. Add any profit you've recognized to date. And then less any amount you've invoiced to the customer. He's here to pay us. That will give us the contract asset. Okay. So all the costs we've incurred, any profit component we want to add up, add it, your markup. And what you've invoiced. Okay. I've invoiced this guy. Subtract it. Or any money he has paid us, subtract it. If he's not paid us anything, that's okay. If we've not invoiced him anything, that's okay. We get our contract asset. On the other hand, if the cost to date will also remain constant, and let's say there's a loss we recognize, we realize that we're making a loss from this contract, subtract it from your contract cost, okay, from the total cost that you've incurred. And then any amount we've received from this guy, from the customer, subtract it. And if your answer goes into a negative, it tells you that you have received more money than what you have actually incurred or put into the contract. You've made a loss, more or less. It's a liability, okay? So recognize it in the other leg as a liability, okay? So this is what we want to talk about over here. Again, satisfaction over time. Let's take one more. Okay. I think we can do that in the next slide, looking at what I have here. We can do that in the next slide. So we'll come back again with the performance obligation where it is being satisfied over time. Hopefully, my screen will not freeze this time round. Yes, it didn't freeze. Okay, so we end it there. We'll come back and continue from where there's satisfaction of the contract obligations over a period of time. Then we can launch into satisfaction again at a specific time. Then we'll look at bill and hold, purchase, sale and repurchase, and then principal agent to wrap it up. And I think that will be the last session, hopefully. All right, friends, I'll see you in the next session. Thanks for now.